Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, let's get you some more market opinion. We spoke with Nilesh Shah of Envision Capital and asked him whether he's still bullish on the IT sector. Take a look.
I think it makes sense to remain constructive on the sector. I think the last 2-3 years the sector itself has gone through a lot of tepid growth, a lot of turbulence, huge changes in the demand environment, pricing pressures. I think all the negatives that you could really flag off have kind of materialized and transpired, and because of which these companies have actually grown in single digits. So clearly the outlook for the next 2 to 3 years I think is very positive on the sector. Because a lot of the new areas I think is going to start contributing a larger share of the revenues for these companies, and these companies have reoriented themselves, but it's still going to be a bit back-ended. So I'm not expecting any of these companies to really stand up today or tomorrow and say that we're going to grow in double digits. I still think that the guidance that they will kind of give out is going to be high single digits at best. So one needs to be a little careful not to get carried away. And I don't think, and I still think they're a few quarters away from stepping into a double-digit growth environment. So one needs to be a bit careful there. I think in the very short term, they could have tailwinds from the rupee-dollar equation. I mean, the fact that now, the rupee-dollar is at 65.40, that really helps the margins in terms of the rupee terms. So that could provide some some tailwinds in the very short term. But otherwise, I think from a 2 to 3 year horizon, I still think that it's a sector to be kind of positive on.
But mid-cap IT has delivered, in some cases even double-digit growth. Do you think that still has enough niche and that can still, do well from here on?
Yes, I think, Anuj, that's really where the big opportunity is within the sector. It's pretty akin to the consumer space where you have the big guys like HUL, ITC who still grow in single digit, but then a lot of the tier 2 consumer names who are in specific niches end up doing well and growing at a much faster pace and at a higher rate. I think technology is no different. Obviously, if you really look at slightly longer term horizon, say the last 10 years, then obviously they have not been able to grow at a faster rate. But the whole world of technology has changed, and honestly, really size is no virtue. So if you are in a specific domain and kind of have solid expertise around that domain, you could end up doing a lot better, growing faster, carrying a much better pricing advantage. And that's precisely what's really happening in mid-tier IT over the last few quarters. And we see this sustaining for the next 2 to 3 years also. So a lot of the mid-cap IT companies who are doing some really nice solid work in a specific domain or a niche, I think they will end up doing much better than the biggies.
The other cue that this market has had to deal with is sudden, spiral back up in crude oil prices and what's happening with, duties, etc. Your thoughts on both oil marketing companies, and on the upside, if you were to look for plays on crude, there aren't too many in our market, but is there something you'd go for?
I think overall the sector is a clear avoid. I don't think one should really be kind of looking at OMCs at all. Given that the next 4 to 5 quarters we are going to be in a politically and an election kind of a period. So in this kind of an environment, that's a sector to avoid, and we really don't see the government or the regulators giving that kind of complete freedom in pricing, which the OMCs can pass on. So I think it's a sector to clearly avoid. But I think on the flip side, some of the engineering companies in this space, they look very good, because higher crude oil prices means obviously more capex in the sector, and obviously therefore more business, more work for them. So clearly within the oil and gas sector, stick to some of the engineering companies in this space. There are talks of some of the other players in the sector who are going to kind of see unbundling of their businesses, and that will unlock value. So some of the gas transmission, gas utilities, I think that's a space to really watch out for versus the OMCs.
What's the consumer durable space looking like for you? It's only consumption stocks that have been doing very well.
Yeah, I think I think the entire consumer space is looking very, very good. I think they've had some bit of a tepid growth environment, but I think the next few quarters are going to be fantastic for the entire consumer space, and more so for the consumer discretionary spend. That's a big kind of an opportunity to really look forward to. The appliances space has turned a bit expensive. Most of these companies are trading between 40 to 60p multiples on trailing earnings basis. So I'm not quite sure as a value investor there's too much of upside in them. But I think the big opportunity within discretionary is basically this whole travel, tourism, hospitality. That entire space looks very, very exciting. Most of the companies here, most of the stock prices have corrected quite significantly in the last few months, and that presents an opportunity there. Some part of pricing power is coming in. There's been a fair bit of consolidation which has happened in this entire space. So I think this entire space called hospitality, travel, tourism, resorts, this entire space looks a lot more attractive versus the consumer appliances space.